For our guest today, we have Mr. Charles Miniex, and he's with the USDA, and he's here today to share with us information about a program called National Homeowners Month. And let's just see what he has to say. Charles, my friend, how you doing?
Doing good, Greg. Good to see you again.
Yes, that's good.
As you said, we are celebrating National Homeownership Month this month. USDA is celebrating the rural families who are working their way into the American dream by investing in a home of their own. This year's theme is Own Your Future, Own Your Home.
Okay. Well, tell me, just how are we going to celebrate this month?
Well, as you probably guessed, for most Americans, a home is the largest single investment that they will make and the largest asset they will hold in their lifetime for most people. Every year, affordable and secure financing through USDA Rural Development direct and guaranteed home loans help tens of thousands of rural residents become homeowners. We also have a home repair program, which you and I will discuss in a little more detail as the program goes on. Through 65 years of delivering housing assistance, USDA Rural Development has helped nearly 3.4 million rural home buyers achieve the American dream of becoming a homeowner. In 2013 alone, the agency helped more than 170,000 people become homeowners and invested more than $23.4 billion in housing loans and grants for rural families. In both people and dollars, 2013 was the most successful year on record in the history of USDA's single-family housing programs.
Okay, well, just stop you right there. This program, you actually loan money out to individuals?
Yes, we do.
For the home? Okay.
Yes, we do.
And what are the steps in order to do that?
Well, if you remember in our first interview, we talked about our direct housing program, where basically the applicant comes to our office, or they can, of course, apply online, email, fax, etc. But basically, we process that application here, and we actually make the loan and do all the work in originating that loan here in the office. We do have another program, which is our guaranteed program, and we'll kind of touch on it if we have time later today.
Okay, well, I'll tell you what, you just mentioned something about when you're making fill out an application with you guys. The homeowner is making a payment to you or to some mortgage company or bank that you're working through?
They're actually making that payment to USDA. It's a direct loan, so they're making that loan. We are actually loaning the money to the applicant. USDA dollars, if you will.
Okay, that's pretty good. So,
but on the other hand, as you spoke about, we do have a guaranteed program where, in that case, the lender makes the, funds the loan. We act as a guarantor, and in that particular case, they're actually making that payment to the lender. Whether it be Chase, American Mortgage, whomever, but it would be that lender.
That's good. As long as we get that kind of cleared up.
Right. And we can talk about the guaranteed a little bit if you like as we go. I think we're going to try to focus a little bit more time on our repair program. That helps folks that have their own home that needs some rehabs done to that home.
So they contact the local office here?
Yes, for the rehab, that's also considered a direct segment or portion of our program. It's not a guarantee, it's directly through us. So when we say direct, we're meaning that you're going to be dealing directly with USDA. Whereas if it's guaranteed, we're you're in the mix, so to speak, but we're not the total player. We're partnering, if you will, with a lender.
That's good.
To actually fund the loan.
All right. Well, let's continue. See what you're going to have to say. How you started? I stopped you prematurely, but
we're going to talk a little bit, if you will, about what it's called our 504 program. That's the technical term that we use when referring to this program. And basically, what we do on this program is help folks, like I said, rehab their homes. One of the requirements, of course, is that you have to own the property. It cannot be a rental property. It has to be something that you own.
Mortgage free?
Well, no, not necessarily. It depends. I mean, the key is one of the requirements is that you own a property.
Okay.
Now, they could have a mortgage on it, and it depends on what type of assistance we're able to give them for the rehab. For starters, most people ask us about a grant. There is a grant portion or segment in this program.
Okay.
But in order to qualify, you have to be at least 62 years of age.
Okay.
And you have to have very low income in order to qualify.
When you say very low, because the poverty rates, I mean, amounts is kind of, it differs every year, looks like.
Right. And just to give a quick example, because I know most folks won't be going back and figuring percentages, but
Okay.
for example, if you're in Lafayette Parish and there's 2 people in the family, the maximum adjusted gross income cannot exceed $25,700.
Okay.
Just to give you a little bit of a gauge.
Okay.
So if this person was to come in, and let's say it's a single person, and he or she is 62 years of age, and their income is $24,000.
Okay.
Okay. If they're by themselves, the maximum for one person is $22,500. So in that
Okay.
scenario, they would make too much money.
Okay.
But if there were 2 in the family and their income was $24,000, they would qualify because the maximum is $25,700.
Okay.
So they would be beneath that max.
Okay.
And that would be one of the requirements. It's not that they would automatically qualify just because of income. We also look at other criteria. For example, if they're 62 years old and we do what we call a budget to see, they have to show that, first of all, that they cannot afford to pay a loan.
Okay. Okay.
So in this program, it's kind of a combination where if they can afford to pay back the money, then we have to look at that option first.
Okay.
So for example, in that scenario, they make $24,000, the income is beneath the very low criteria. They're 62, or at least one member is at least 62 years old. They do qualify for a grant provided they don't show repayment ability on a loan.
Okay.
So which brings us up into the loan criteria. If the person shows repayment ability, in other words, to give an example, they want to borrow $10,000 to rehab the home.
Okay.
Our loans under this program is at 1%, simple interest rate, and we give them a term of at least 20 years. That's
20 years.
So in that,
Fantastic.
yes. So in that scenario, if they were looking at repayment of a loan of $10,000 at 1% for 20 years, that would come out to approximately $45 a month.
Okay.
So if we did a budget and it showed that they could afford to pay the $45, then they would not be eligible for a grant. We would have to make them a loan.
Okay. So really, for that individual, you can adjust the payments to meet their ability to repay.
Well, not say that we adjust. We look at, we do a budget. In other words, when we do a budget, it's basically, we look at food, we look at clothing, we look at transportation, we look at how many debts they have, their whole financial portfolio, if you will, and determine, after assessing all of these costs, in other words, you got to pay electric, you got to pay gas, you got to pay insurance in your car and house. Once we factor in all of these expenses, and let's say their income is $2,000 a month,
Right.
and at the end of calculating all the expenses that they have, they're only spending $1,950.
Okay.
That means they got $50 left at the end of the month on average that they could utilize towards paying a loan.
Okay.
But in that scenario, they would have to look at a loan.
Okay.
Now, let's say, for example, we took that same case, 62 years old, the income fits, and we calculate their debt load, and they get in $2,000, they make $2,000 a month, but they're spending, it's taking them more than $2,000. It's taking them $2,100. Really, they're having to squeeze, and sometimes things are running behind because they can't really make all their obligations. Then in that case, they could qualify for a grant.
Okay.
Now,
okay.
our grant though is limited to $7,500.
Just $7,500.
$7,500. So in the scenario that I gave, where if they need $10,000 to fix the house, then all we can give them is $75,000. Then we have to look at, will that $75,000 remove all of the major health hazards in the house?
Major
Health and safety hazards.
Okay.
So for example, if let's say for example the house needs to be lifted and it's going to cost $7,500 to do that, and it needs a new roof,
Okay.
and that's going to cost $7,500.
Right.
And they can't show that they can pay back a loan, well then we're not going to be able to help them because we can't remove all of the health and safety hazards to that home.
Okay, so you really try to make it happen for them.
Well, we're going to do our best.
Yeah,
But in most cases today, it costs quite a bit. On an average house, it costs about $6,500 to $7,500 just to do a roof, replace a roof.
How much?
So, yeah, about $6,500.
You're right. I just had mine replaced.
So it's pretty expensive. And so what I'm saying, I guess, bottom line is, if the home, there are situations where the home is beyond repair
Okay.
or beyond our reach.
Okay.
So if that be the case, let's say, for example, in that scenario where they need the 10 or they need 15 and they don't have repayment ability, all they can afford is the grant. Well, and it's they might say, well, okay, well, just give me the 75 and I'll do the rest later. Well, we can't do that because, for example, if we did, let's say it was the foundation, but the roof is leaking. Well, if we don't fix the roof soon, we just
Doesn't
wasting
matter.
money
Yeah.
because what's going to happen is the roof is going to continue to leak, and then it's going to mess up the foundation that
Yeah.
we spend money on. So we want to make sure we're using the highest and best use of the taxpayers' dollar.
Okay. Well, I tell you what, I want to stop right there. This is going to finish this first segment, and we'll be right back. We're back with Mr. Charles Miniex, and he's going to continue to share with us information about the programs that he and the USDA has. Charles, where did we leave off, man?
I think we were talking about repairs and our 504 program, and I think we were talking about situations, scenarios where we might be able to help, and in some cases we can't help. We're going to do our best to help everyone, but of course, as we know, reality is that we can't help everybody.
Right.
There are some cases where we can't reach them, but we're going to give it our best shot. So basically, to start, if someone is interested in this program, I would encourage them to contact us, and I'm sure we'll have that information at the end of the segment, which gives our contact information. But if you got questions, please give us a call, and we can look at your specific situation and let you know whether or not you might fit or might not fit.
Okay.
But basically on this repair program, it's a really good program. There's no fees, there's no origination cost. All of the money that you get will go towards your repair. It's not like we're going to take some out of that $7,500 to cover origination costs, the closing costs, etc. So it's a great program. It's free money, and the only thing is you have to sign a statement that you will not sell the property for at least 3 years.
At least 3 years.
Yes.
Okay.
So again, it's a great program. There is a waiting list, and I must let them know that if you're applying today, it's not something that's going to happen in 2 weeks or a month, because we do have a lot of applications in the queue that are awaiting funding.
Yes.
We only get a limited amount of money for that. We do have, however, more money in the loan pot than we do in the grant pot.
Okay.
And the grant loan is another great program, like I said, where you're getting 1%, no cost as far as to get this money.
Right.
We give you 20 years. You can pay it off early with no penalties.
Okay.
So, and basically, if you're borrowing $7,500 or less, basically we don't even take a mortgage on the property. We just let them sign a promissory
A signature note.
It's a signature loan like a credit card. So, I mean, it's really a great program.
Yes,
And
it is.
the maximum we can do on the 504 loan is $20,000.
Okay.
So just going to the max on that side, just to let them know we can go up to 20. So your maximum assistance would be, if you qualify, we could get somebody that qualifies for, if they got a lot of repairs, and they say, well, okay, we can afford that $20,000 loan at 1% for 20 years, but we still need a little bit more money to get everything done.
Right.
Then we would throw in that $7,500 grant,
Okay.
provided they're 62 and they meet the other requirements.
Okay, that's
So
good.
It's a great program, and like I said, for the loan, you don't have to be. I want to emphasize that you don't have to be 62 to qualify for the loan.
Well,
So if you're less than 62 and you own your own home and it needs some refurbishing, we can still help you.
right. Well, I'll tell you what, Katie, you need to take advantage of this program, really.
It's a great program, and of course, when we do look at a loan, there are credit requirements. So again, we do have to look at a credit report once we get to looking at a loan.
Okay. Well, I'll tell you what, we have about 5 or 6 minutes left. What other programs that you want to talk about to let the community know just what USDA has to offer?
Well, what I'll talk about next, Greg, if we can, and that's considered our guaranteed housing program. We touched on it a little bit earlier about, when somebody makes an application, where they make the payments, etc. We talked a little bit about guarantee, but I want to emphasize that our guaranteed program is designed for moderate income families. These are families that's making a little bit more money than they would not maybe qualify for our direct program.
Okay.
For example, on our guaranteed program, we have a range from 1 to 4 people in the family. The maximum income is $74,750.
Okay.
Significantly more money than we can do with our direct program.
Right.
So if you and the spouse of the household income is closer to that $70,000 range, this would be an excellent program. There is no down payment requirement. There is, in this particular program, we network basically with lenders.
Okay.
And that lender would actually make that loan with the understanding that we provide a guarantee.
Okay.
And that makes that loan, for most part, when you go in for a loan on the commercial side, if you will, or should I say for a home loan,
right,
you normally would need to put a down payment.
Like conventional loans where
exactly, that's the word I want to use.
Yeah.
So this way you don't have to put anything down. We do 100% of the market value of the property.
Okay.
So if you're buying and one of the good features of this loan program is there's no loan limit. So for example, if you're making a little more money than for our direct program, and you decide that you want a $200,000 house or $300,000 house, and you show that you can make the payments on it, then it is something that is possible for us to help with.
Okay, so do we still go like 20, maybe 30 years with that type of loan?
Well, this loan is for 30 years.
Okay.
And the rates are set by basically your
Prime
VA,
plus 2 or whatever,
VA or Fannie Mae rates, which is right now running somewhere between 4 and 5%, which is a great rate. And basically to get information about this program, they can call us or go to the yellow pages, look under mortgages. You can contact a mortgage broker, or you could contact a lender directly, such as a bank, and see if they participate in the program. And if they do, you put your application in with them. Whether you call us or not, you actually still have to apply with either the lender or the broker. We'll only be able to refer you to information to make the contact, but because it's actually their loan, we're actually acting as an endorser. Which helps that banker or that lender to be a little bit more flexible in working with you because you don't have that down payment, but with our endorsement, that allows them to have the security that they need to make this loan. So it's a really good program. If you got more than 4 people in the family, the income jumps up to $98,650. So you can make a substantial amount of money in this program and still qualify.
Okay.
Like I said, there's no maximum loan amount.
As long as you can pay it back.
As long as you can pay it back. Basically, we look at ratios when we determine repayment, and that's what the lender is going to look at.
Okay.
In other words, they're going to take your gross monthly income, and typically they're going to look at somewhere between 41 to 43, 44% of your total debt load should not exceed that percentage.
Okay.
So if you're making $5,000 a month income, then 41% or 40%, just for quick math, would be $2,000.
Right,
so,
right.
We're saying that you shouldn't have all of your debts together should not exceed that amount, typically. But there are some exceptions provided. For example, if you got excellent credit, you show that you're a good manager, sometimes there is a little flexibility in allowing a little bit more on that back-end ratio.
Okay.
So,
because you said about credit rating, what are you looking at? Would you go as low as maybe 650?
Credit score?
Yeah.
Again, it's not score driven specifically, but typically if you got a 640 or better, you should be in the ballpark.
Okay.
And I'm not saying you have to have a 640 because the credit reporting it's not a perfect science. So
Right.
in some cases, you'll see somebody that got maybe a 620 and have basically really good credit, but just the way that they score it, it happened to be a little bit lower. So,
But there are also life's instances come up every now and
exactly,
then.
some circumstances beyond
Yeah.
your control.
Yeah,
So
yeah.
those things can be considered, but again, within reason. I mean, if you got a 500 or less, in the 500s, then chances are a lot less likely that you're going to qualify.
Mhm.
So just being on the real side as far as the numbers, but again, each case is looked on as an individual report. So we're not going to look just at the score and turn you down.
Mhm.
So we will look at, like you said, those situations that might be a circumstance beyond your control, an event that you had perfect credit and this event caused a drastic decrease in your
Yeah,
score.
because I do know life gets in the way sometimes.
That's correct.
And for Acadiana to have this type of program that's available to them, you should take advantage of this for those who are in the rural areas, right?
Right. And
It's not
basically,
in city limits.
a good point, Greg, rule for my area, I cover 14 parishes, which is the southwest portion of Louisiana.
Mm-hmm.
And out of those 14 parishes, there's only 2 places that we cannot make loans. And that's in the city of Lafayette and the city of Lake Charles. Everything else is considered rural. Our definition of rural is a population less than 35,000 people.
Okay.
So Opelousas, Crowley, Sulphur, New Iberia, all of these towns qualify for this program and our direct program.
Well, I'll tell you what, this is going to end our segment, and hopefully we can get Charles back in the future to see what he can share with us to help make Acadiana better for everyone. Charles?
It's great, Greg, and
Okay, my friend.
appreciate you.
Thank you. Goodbye.